If you ever heard of the terminology the candlestick anatomy theory or candlestick anatomy in general, I'm actually the originator of this specific model and terminology. And over the last 2 years since I've been teaching this specific, it's actually gotten some traction with other traders and people are starting to learn about it more and more. In this video, I'm about to break down exactly what the candlestick anatomy theory is, the different components of utilizing the candlestick anatomy, and how you can put it in conjunction with your trading to make you a much more consistent powerful trader. The 3 specific ways that you can utilize the candlestick anatomy to make your trading a lot simpler when it comes to understanding daily buys, when it comes to entries, as well as planning your trade, so your trading becomes a little less stressful and a little bit more consistent. Well, the only thing that I ask from this video is that you watch to the end, because it's step by step by step, and I don't want you guys missing a single step, as this is one of the most educational videos that you'll ever watch. It's going to help you become a consistently powerful trader. Just before we begin, if you are a beginner trader or you've been losing for some time, I do have a coaching program where I have been able to coach well over 100 students and help them become profitable. So I want to help as many students as I can. So if you're a beginner trader or been trading for some time, you want me to coach you one-on-one to become more consistent, click the first in the description, book a free call. You get to talk to me personally. I see where you're at, your goals, and how I can help you and build out a plan. Just clicking the first in the description and booking a free call. The candlestick anatomy theory is pretty simple. Obviously, we can take note of this candlestick to our right here. This candlestick is referred to as our higher time frame candle, and this higher time frame candle can be a couple things, right? This could be a daily time frame, 4-hour time frame, as well as this can be a 1-hour time frame. And typically with this higher time frame candle, it's in alignment with lower time frame structure. If we're looking at the daily time frame, we typically want to be trading on the 1 hour for our overall level of structure, liquidity, entries, and everything like that. Time frame is the 4-hour. We want to be looking on the 15 minutes. See, on the 15 minutes, this is where we mark out our market structure, liquidity, entries, everything like that, the lower time frame where we're trading on. For the 1-hour time frames, we want to be looking at the 5 minutes, looking at market structure, liquidity, entries, basically the time frame we're looking on. So this higher time frame candle is our representation of our higher time frame, and we're basically looking for the overall structure on the lower time frames relative to the higher time frame. And I'm about to break that down here very simply. Say this higher time frame candle is the 4-hour time frame, so we're going to be looking at the 15 minutes. And when it comes to the candlestick anatomy theory, it comes into 3 phases. See, the first phase is when we open up. The next phase that price goes into is obviously the manipulation, right? So if we're anticipating this 4-hour candlestick to be bullish for the day, we want to see price open up and initially go lower. We want to see it go lower to find a level of support. Once price finds a level of support here, this is referenced as our manipulation. Basically, a lot of traders see the market going lower. Most likely they're shorting the markets, chasing, and those traders are soon going to be stopped out because they are unaware that the higher time frame we're anticipating higher prices, right? This is how you lose less in trading. How you lose less in trading is by planning your trade. If I'm anticipating higher prices, I'm not going to be getting faked out when the market opens up and goes lower, because that's exactly what I want to do. But once we see price see this break to the upside here, basically it comes down into a level of support and then it immediately runs away from it. That's our overall confirmation. Price has given that manipulation that it needed. Either frame our entry down here. This is referred to as our low risk buy. Just in case if you missed the entry down there, price gives you 2 other opportunities. It gives you another opportunity right here, and it gives a pullback following that initial break higher. A second opportunity right here for a second pullback right there for establishing the high and finishing the range. And this is what happens on a consistent day-by-day basis. It comes into 3 phases. First, you have the opening phase where the market simply just opens up. Second would be that manipulation phase where price goes in the opposing direction first to establish a low, right? Since we're anticipating higher prices, we want to see price establish a low first within a level of support or liquidity, which we'll talk about later on. Then following establishing that low, we want to see price break in the opposing direction. Usually it gives 3 phases. First is the low risk buy, first accumulation, and then second reaccumulation. It's the general gist of the candlestick anatomy theory, basically utilizing the higher time frame candle in alignment with a lower time frame structure. And if you're still confused, don't worry, because we're going to go into a second step, which is the overall profiling. Second step we're looking over is CAT profiles, and there's specifically 5 profiles that happen throughout the day. This is also in alignment with time and price. So the first thing that you want to take note of is the overall session. So an indicator that I utilize is called the kill zones by @Joshu. So go into indicators, type up kill zones by @Joshu. It simply marks out the AM session for the New York, the London session, Asia session, then the PM session. So specifically, me myself, I trade the New York AM session. So this session ranges from 8:30 a.m. EST to around 11 a.m. EST. During this time frame, I'm looking for one of these 5 specific profiling. So the first profiling within this New York session, this would be referenced as a classic sell day. Basically, where 8:30, as you can see, opens up right here. You see, this is where it closes right here. So we're basically just creating a candlestick here. So this right here would be the body where we open up to close. This would be bearish, and then right here, this is where we create that high. This is where we create that low right here. Right here would be referenced as a classic sell day. It's basically when the market simply just opens up and sees a drop to the downside. And it's important to understand that every single day price creates a bridge. The reason why this is very important is because this is the backbone of daily buys and creating a plan. Do we start? Do we finish? So it isn't necessarily to predict the markets, but it's simply to identify where I am within the bridge. Am I anticipating price to go higher, or am I anticipating price to go lower? My overall idea is to frame an entry within the middle of the bridge. How you know where a bridge starts and how you know where it ends is usually referred to these 2 things. First would be liquidity, second would be inefficiencies. Liquidity is pretty simple. It's original highs and original lows, previous day highs and previous day lows, as well as it can be prior session highs and lows. In this case scenario, this was simply an equal high, a regular high point within the markets, where you can clearly see price came higher to take out this high, and then after taking out this high, you can clearly see price could not continue going higher. Following not continue going higher, we can see this break to the downside, creating this break of structure lower. You look at this example from this liquidity sweep with this breaker structure to the downside. Would you say that the market is bullish? Probably not, because clearly it's signaling that once price took out this high point, it did not want to continue going higher, and instead it's seeing a drop to the downside. I'm not trying to predict the markets. I'm not trying to be better than the markets. I'm simply just understanding what is it trying to tell me. Where a trade starts or where it ends is reference to liquidity and inefficiency. So for where this trade starts, it's reference to liquidity. As price came higher, took out this original high, and it could not continue going higher. Instead, it reverses low. Now, where does this trade end? Here, this trade ends when price comes down into this fair value gap. This is what you call a unmitigated fair value gap. It's basically a fair value gap that has yet to be tapped into, meaning where you can clearly see price creates this gap within the market and it never came down into it. So this is a level that price has never tapped into, meaning that it's unmitigated. So obviously, where does this trade end? This trade ends within a inefficiency. The price comes higher to take out a level of liquidity. We're simply shorting the market, anticipating it to go lower to reach down into a inefficiency. As the market opens up at 8:30, how you create your daily buys is pretty simple. Did the trade start, and where do we get a break of structure? It breaks through this bullish fair value gap. This right here is a bullish fair value gap. Separation between the first candle's high and the third candle's low. When price breaks through this level, this is the break of structure right here. It breaks through this bullish fair value gap, meaning that price does not want to go higher, and then it breaks below this low. You want to see price take out an area of liquidity or maybe tap into an inefficiency and then immediately go away from it, breaking structure. Price took out this area of liquidity, then immediately ran away from it, breaking structure. In this case scenario, once price creates this break of structure lower, price revisits this once bullish level. It's now turned resistance. So right here would be where you frame your short. Stop loss back above this high point right here. Obviously, reach back below lower prices, back down into this fair value gap. And you can clearly see this would be referenced as a classic sell day, where the market simply opens up and sees a drop lower. And you can clearly see how we created our bridge. Price opened up, pushed higher, took out this high point. This is where it starts. Broke a structure to the downside. That's the confirmation. Taps into a level of liquidity or inefficiency. Once price breaks structure, it should not come back up here. It shouldn't. We get that break of structure, confirms that this is where it starts, and we can reference fair value gaps as areas of entry to reach back lower into opposing areas of liquidity or opposing areas of inefficiency. In this case scenario, we had multiple areas of liquidity. We had this low right here, which you could have taken profits on. This low right here could have taken profits on, and then obviously the fair value gap right there, taking profits there. Another CAT profiling would be a classic buy day. day. Exact exercise, let's do it once again. So where does it start? Marking out the overall bodies. So right here, extend this forward where the overall candlestick opens up is where it overall ends at around 11 a.m. EST. So from 8:30 to 11 a.m. EST, this is the overall low right here, was this is the overall high right there. This would be referenced as a classic buy day. Create or bridge. Market will refer back into one of two things, either liquidity or inefficiencies. So in this case scenario, our bridge starts within a inefficiency. So we can clearly take note of this fair value gap right here. You see price comes down within this fair value gap right there, level of support right here. Basically as 8:30 opens up, then we see this pop to the upside structure right here. Right here is our breakout structure. Price taps into this fair value gap here, and we break structure to the upside, did not come back down here. So we're on the 15 minutes time frame. This higher time frame candle is our 4-hour. Anticipating this 4-hour candle to reach back above higher prices. Once price taps into that level of support, followed by that break higher, it should not come back down here. Would we be targeting? We will be targeting levels of liquidity or opposing levels of inefficiencies. Take a note of a couple things. First thing that I can take note of is this unmitigated fair value gap right here. Very tiny fair value gap right there, which you can clearly see price comes back into perfectly. Very tiny unmitigated fair value gap right there, which you can clearly see price comes back up into, as well as we have multiple highs. This first high right here, that would be like a 1 to 1 hour target. Can high right here, or so of a 2 to 1 hour target. Obviously we have these highs back up here with that unmitigated fair value gap all the way back up there. A 3 to 1 hour target where the trade starts, where price taps into either level of liquidity or inefficiency. In this case it tapped into an inefficiency, followed by this break higher. This is where the trade ends. Either you want to take profit up here for a 1 to 1, either you want to take profits up here for a 2 to 1 hour, or you want to hold it a little bit longer for a 3 to 1 hour. So in this case scenario, once price pulls back within this fair value gap right here, it would be referenced as your entry. I'll bounce back below this low. Let's see, and reach back above these high points. See, reaching all the way back up there perfectly. So right here would be referenced as a classic buy day. Simply just opens up, goes higher. Usually classic buy days or sell days happen in the market prior to opening up or during as it's opening up, taps into a level of inefficiency or a level of liquidity. So in the prior lesson, we can see that before the 8:30 opened up, it took out an original high, and as 8:30 opened up, it went lower. Compared to this example, as 8:30 opened up, you can clearly see it opened up and went lower, tapped into this fair value gap to find support to go higher. This is where the market opens up right here. This is where the market closes right here. This is a sell day. You see price opens up where we established a high up there. This is where we established a low down here. This right here would be a sell reversal type of day, and it's pretty simple. It's where the market initially opens up and goes higher. It goes higher to manipulate, and then it goes into your favor. So right here, right, this is our 4-hour time frame hitting the 15 minutes. Looking at the inefficiencies within this 15-minute time frame to basically garner us a direction for where this 4-hour is going to close. So above us, we can take note of this bearish fair value gap. You see price creates this bearish fair value gap right there, mitigated, meaning price never tapped into it, and below it we have levels of liquidity, which was these original highs. Bam, price opens up, goes higher. This is our manipulation, and the reason why we know this is our manipulation is because we have levels of resistance and liquidity above us. I'm not going to be buying here. We're clearly within a bearish fair value gap. It just doesn't make sense, while the market has already been making consistent lows. The reason why you keep getting faked out or losing on your trades is because you're not creating a plan or establishing what you're looking for before you start trading. Before I start trading, I take note that I'm within a level of resistance, understand that we're in an overall downtrend. So as the market opens up and it goes higher, I'm not chasing it higher, but I'm seeing it go higher into that resistance level. This gets us into our overall third step within the candlestick anatomy theory, which is candlestick confirmations. See price tap into these resistance levels, want to see a rejection from them. So this right here, price rejects from it, where you can clearly see it creates this wick lower. When it comes to the support and resistance levels, you want to see price tap into it and immediately run away from it. On the 15 minutes time frame, you want to see this specific confirmation where price taps into that level, takes out that area of liquidity, or taps into a resistance level, then rejects away from it. Here would be your candlestick confirmation or your candlestick anatomy. Candlestick anatomy theory is simply utilizing the higher time frame with the lower time frame structure, and candlestick anatomy specifically is the specific candlestick confirmations where price opens up, comes higher, taps into a level of resistance, and then it closes bearishly. This is referred to as a rejection wick. You want to see price create a confirmation running away from the liquidity pool or area of inefficiency, which in this case we had both. We had a liquidity pool above these highs and inefficiency right here. We got the right confirmation running away from it, breaking structure to the downside, breaking back below this bullish fair value gap, comes back higher into that level. This was once a level of support. Now it's used at resistance, which you can clearly see price comes back within it, rejects from it right there perfectly. And this is a great signature. It opens up, comes back into that inefficiency, and it rejects away from it. This is the exact confirmation that you want to look for within candlestick anatomy. It's basically signaling price was not willing to continue going higher, and it's respecting this level. So as price rejects away from it, frame a short, stop loss back up here below lower prices, which in this case we had levels of liquidity down here. Look to our left here, we have levels of liquidity down here as well, and we had a level of liquidity all the way back down here. It was a prior weekly low. This right here would be our level that we're reaching down into. Right here would be our overall trade for that day. You can clearly see this is a sell reversal where the market initially opened up, rallied higher. A lot of traders got faked out, but we were patient and we created a plan. We knew price was going to go higher because it had this fair value gap here. Once price tapped into that fair value gap, it gave this candlestick confirmation, basically not trying to go higher, but instead rejects from it. Then as it gives this breaker structure below the bullish fair value gap, that's our additional confirmation. Price is breaking through levels of support. So once it retests it, finds resistance to go lower. And our next example, this is our buy reversal. This is where that market opens up right here. This is where the market closes, then creates our body, our high point. This is our low point. See, a buy reversal is pretty simple. It's where the market initially opens up and it comes lower, then eventually reverses in the opposing direction. It opens up here, creates this manipulation to the downside. Remember, this refers back into liquidity and inefficiency. So within this area, you can clearly see price has this bullish fair value gap. The market opens up, comes down into this bullish fair value gap, and what we want to look for is obviously the candlestick anatomy, the confirmation, which is the rejection. See, once price taps into this 15-minute fair value gap, it immediately rejects away from it, breaking structure to the upside. It's right here, your overall confirmation taps into that 15-minute level, whether a liquidity pool or an inefficiency, and it immediately rejects away from it. Our first idea that price is finding support within the support level, and our second, which is a confirmation, is when price inverses a fair value gap, basically breaking above a bearish fair value gap, breaking structure to the upside. In this case scenario, there isn't a fair value gap, but there is this high point. You can clearly see price break above. So this right here, from this rejection to this break higher, confirms that this is the low of that higher time frame candle, confirms it. So now that we know that this is the low of that higher time frame candle, we're anticipating this higher time frame candle be bullish. So we had that opening right here, then we had that manipulation to go lower. Now that we're back above this opening breaker structure, it should not come back down here. We're simply just waiting for a pullback within either an inversion or a bullish fair value gap, which in this case scenario, price creates this bullish fair value gap, finds a level of support right there. Obviously we would be targeting areas of either liquidity or inefficiencies. In this case scenario, we are at all-time highs on gold, so there is no areas of liquidity or inefficiencies, so we would simply just be aiming for a 2-to-1 R. You can clearly see price does eventually get back up there. Our traders shorted this thinking it's going to go lower, and then it eventually reversed going in our direction. But not least, gets us into our last profiling, which is our seek and destroy profile. And this is basically our consolidation profile. Price simply consolidates within a specific range. This is where the market opens up, is where the market closes right here. You see there's no fair value gap here, and the only liquidity pool is down here. There's no start to the bridge, so it means it's a little less probability, but can still take a trade within this. How you would take a trade within this is by referring to the breaker structure and the rejection. Even though it did not tap into a level of inefficiency or liquidity, price still came lower and it gave this rejection here. So this right here is the candlestick anatomy. This is the rejection wick. The price comes lower and rejects from it, and then it gives this breaker structure within this fair value gap. In this case scenario, instead of immediately taking a buy within this fair value gap, you want to look for another rejection within the fair value gap to confirm that it's found support there, which it gives right here. Once price closes above this bearish fair value gap, you can clearly see price opened up right here, come lower, give this rejection, and then pushed away from it. Right here is your overall confirmation. Price has found support here, and it's now finding support within this bullish fair value gap. In this case scenario, once you get this rejection, you can frame along, you can trust that your stop loss is down here, even though it didn't tap into areas of liquidity or inefficiency. Simply want to aim for small profits. So right here, I'll just be aiming for about a 1-to-1, pushing back above this high point scenario. Even though it is more so of a consolidated market, I was still able to anticipate during these type of consolidation days, rather look for smaller profits profits, or sometimes they can be losing days. But that's completely fine. No day is perfect. If you do have a consolidation day or do lose in a single day, don't try to beat yourself up. Understand it's part of the process and you just keep it pushing. Those are the 5 specific profilings that happen within the day consistently. And we talked about what is the candlestick anatomy. We talked about the overall profilings, which this is the last profiling. And then last but not least, talked about the candlestick anatomy confirmations, right? Which was obviously the rejection wick, utilizing the higher time frame candle with the lower time frame structure. If you're more so of a scalper, you'll utilize the 1 hour with the 5 minutes, day trader like myself, so the 4 hour with the 15 minutes. And if you're on a higher time frame, daily time frame, and you're trading on the 1 hour. But that's gonna be it for this video. I hope you guys got a lot of value from this video. And like I mentioned, I am a training coach. I help traders become profitable, and I've helped well over 100 students become profitable or help them make the first $1,000, $5,000, and even $10,000 trading. So if you got value from this video, you want to trade live with me every single morning, weekly coaching call, my full curriculum to help you go from A through Z, click the first description, book a free call, talk to me personally. Let me see where you're at in your trading journey and how I can help you. If you want to watch another video going over my max win model that helps make me $10,000 every single time I take it, it's my one shot, one kill, or my forever model that I look for consistently 1 to 2 times a week. So if you want to watch that video is about to pop up right now. Make sure you guys leave a like, comment what you guys think, and subscribe if you're new. I'm Arkham. Be safe.